my name is Jerry Guger, Investment Communication Strategist at Manning & Napier, focused on bringing you the unique views and perspectives of our firm. And I'm excited to be joined here today by Beth Millett. Beth is a senior analyst in the Capital Goods and Services Group. She's been with us since 2006. And before her time focusing on what she does today, which is industrials, cyclicals, chemicals, energy, she was also an analyst in our real estate group, where she still is a portfolio manager today. Beth, welcome.
Thank you.
And I'm also joined here today by Ethan McKinney. Ethan is a senior financial consultant in our Western New York region, having joined us from the University of Rochester in 2005. And he is responsible for coordinating all aspects of client relationships, including both investment and financial planning discussions. Ethan, welcome.
Thank you.
And our agenda today is as follows. We're going to briefly do an introduction, and Ethan will introduce a theme you'll see throughout the course of today's event. And then we'll discuss the quarter that was, the key concerns I was discussing a little bit earlier, including inflation, economic growth. And ultimately, after that, we'll talk about what we're doing in portfolios, as well as with your financial plans. And as we go through the event, you'll see a little bit of history and context throughout, and I'm certainly excited to share all of that with you. And then after that, we'll do Q&A. First, pre-submitted. Thank you all for pre-submitting a number of questions ahead of today's event. We selected a few that occurred more than once, prepared some brief remarks, and we'll share those with you towards the end. And then after that, we'll do live Q&A. And as a reminder, as is the case with all of these quarterly events that we do, we encourage you to submit any questions you may have throughout the event by clicking on the Q&A box on your screen. And lastly, before we begin, I'd like to turn it over to Ethan to discuss the importance of context and perspective, I believe.
Thank you, Jerry. Thanks, Beth, and thanks for all of you for taking the time to join us today. So when we prepare for these webinars each quarter, we sit around a table and think about what are the key topics that are on investors' minds. And in some quarters, those topics can be wide-ranging. Today, that is not the case, at least from what I've seen. Most of the discussions I've had in the last few weeks and few months have been very focused, specifically on the national debt and the budget as related to that. Concerns about not just inflation that has occurred, but the potential for rising inflation from here. And then a lot of the legislative impacts from tax proposals and the like. And quite frankly, none of these are necessarily new ideas or new questions out there. They may be more relevant today. I mean, inflation is a little bit more in focus right now. But they need to be managed around, which gets to the theme today, which is focused on the long term, but managing for the short term. As a firm, Manning & Napier understands the need to manage through these issues. But we're going to focus today on discussing these topics. We think it's important to educate our investor base. We're going to help you better understand how these different ideas will impact our investment decisions going forward. But then finally, we're going to really focus on how they impact you, the end client or investor, because quite frankly, that's what's most important.
Yeah, absolutely. And in a lot of cases, it's really the distinction between the signal and the noise, or basically how much of what you're really hearing is actually impactful and decisions should be made upon versus just noise that must be monitored but generally observed. So, I mean, speaking of signal and the noise and moving on to exactly what happened over the quarter, there was a decent amount of noise, particularly at the end. And we know, at least with domestic equity markets, the stock market got a little choppy towards the end of the quarter. There was a lot of headline risk around what was going on in Washington, D.C., and other major issues. Beth, I guess I would turn it over to you and ask, what was your perspective as you think about the third quarter that was?
Sure. Yeah. And thank you very much for having me participate in this webinar. I'm looking forward to it. And yeah, this quarter, I would say, is one in which we saw volatility start to pick up after a pretty quiet year to date. Markets have had a strong year so far. The S&P is up 20% year to date. But it's pretty much flat since September, just illustrating the fact that we have seen some of that volatility picking back up. It's been a little bit of a tougher go. Ethan touched on some of the reasons for this. Certainly a lot of concerns starting to bubble up on the level of debt in the economy after a lot of money was pumped in after COVID. We also are seeing those concerns starting to pick up on inflation on the back of all of that stimulus. And then, rising taxes are playing a role, as well. So we'll talk about all of these topics. But one thing I want to begin with, and then just make sure that we also end with and leave you with, is that there are always uncertainties in markets and economies. And oftentimes these environments are what give us a lot of opportunity, both in terms of stock selection and bond selection, but also in terms of asset allocation. So I'll turn it over to Ethan to start us off on some of these key topics we want to cover today.
Thank you, Beth. And the chart that's on the screen right now, as you had mentioned and we said earlier, the third quarter was the most volatile quarter we've had in quite a while. And what catches my eye is the month of September. I may be a glass half full kind of person, but I understand that the fears when things start to slide in the other direction. And the question is not, what did markets lose in September? It's where do we go from here? And this chart is a calendar quarter illustration. Interestingly enough, I did look at, as of this morning, the S&P is actually bouncing back around all-time highs where it was a month or two ago. And so, and the reason for that, a lot of it is that what legislation may pass domestically, what else is going on globally related to COVID and other issues out there. But this legislation is a big deal, Beth. And maybe we start off by talking about the federal budget and the debt and debt ceiling out there.
Yeah, sure. Thanks, Ethan. I guess I would say just taking a step back and looking at what do we think this means, going forward from here. We certainly have had a ton of stimulus that's been pumped into the economy. And we think that as we move forward and that stimulus, the impact of that spending starts to roll off, we will see headwinds, to growth. It's kind of inevitable. And so we do expect we're going to be moving into a slower growth type of environment, something more similar to the environment we were in when we headed into COVID. And I would say, it's always very difficult to sort of precisely pinpoint where it is we are in the economic cycle. But I'd say we're confident that we are moving past that early cycle environment coming out of a recession. And we're moving through that mid-cycle environment now, heading towards a later cycle environment. And when that happens and we move past this sort of stimulus-driven growth, we are going to be moving into a lower growth environment. And that's typically an environment where you can expect to see lower, returns going forward.
Yeah, and if I could add too, not only are we already moving out of that early cycle environment into something more middle-ish or beyond, but that is an incredibly quick time. I mean, really unprecedented for how fast we went from early spring last year with one of the deepest contractions in US economic history towards the aggressive bounce back, and obviously stimulus playing a big role in that. I guess I would say, rolling on to that very next topic, the other side of the coin of stimulus and all of that government spending is what kind of downstream impacts that's having on the economy and ultimately on inflation.
Yeah, thanks, Jerry. I mean, yeah, definitely. Let's talk about inflation because it's something we're getting a lot of questions on. It's a big topic in the headlines. And, frankly, we are seeing an uptick in inflation. It is important to remember that in any economy, some level of inflation is actually good. It's a signal of a growing economy. And when it becomes a problem is when the consumer can't absorb it. The consumer has a demand response. They can't pay the higher prices, they stop buying, and this demand response destroys growth. And that's when you start to get into the type of economy that starts to stagnate and you start to see sort of the more nasty impacts of inflation. When we look at the consumer today, we have a very healthy consumer. Savings levels are very high, debt levels are very low, they have a lot of disposable income, home values have risen, credit scores are up. And so the consumer is in very good shape. And as such, we've seen very little in the way of demand destruction so far. We also, have to acknowledge that a portion of this inflation will prove to be transitory over time and is being driven by COVID-related factors, manufacturing shutdowns that have occurred, due to lockdowns, due to illnesses in manufacturing chains. We think that these things will start to ease over time. We also know that demand will eventually normalize. It's at high levels right now. As I said, consumers are very healthy. There are also are investments going into the supply chain, and as those flow through, they will help ease this as well. So definitely a portion of this inflation we view as transitory. Some portion of it may prove to be stickier over time. However, we don't see the case right now for a longer term view on, sort of a runaway inflation type of environment. And I'll let Ethan touch on this topic as well.
Thanks, Beth. I will say that I do agree with exactly what you're saying there. And I want to build on a few of those ideas. With the idea of it being transitory, I deal with a number of business owners, specifically in the home builder, electrician, plumbing space, and similar professions, and they've highlighted concerns to me about the impact of inflation on their business. We'll share slides like the one that's on the screen right now that shows an uptick of inflation, but with a muted level of maybe a 4 to 5% year-over-year number. In some areas of the market, it is quite higher. When you look at raw material costs, some of those are 15, 20, 30% or greater. And so some businesses have been impacted more and have had to pass those costs along in other ways. But the reality is, I'm going to say, again, acknowledge that what you said is 100% true. That the consumers overall are healthy. Consumers are doing well. The individual investors that I work with, despite the appearance of many goods costing quite a bit more, have not actually really spent any more money in the last 12 months than they had in the 12 months prior and the 12 months before that. And there are a few factors there. One is, despite some of these supply chain issues out there are a number of headwinds to inflation that we believe may help keep some of these figures at bay over the long run. And those are some, technology innovations, automation, globalization in the marketplace, and quite frankly, what you could call the Amazon effect, where there's a company out there that can cut prices and keep some prices globally in check. So there are inflation concerns out there, something that we are monitoring as a firm. But fortunately, there are a number of headwinds that we hope will keep things at bay and have helped allow the consumer to stay generally healthy at this time. One additional headwind to inflation potentially is tax reform. And so fiscal policy in the form of tax rate hikes is also on the table right now. And this is a sticky topic, something I tend to tread lightly on in any conversation that I have. But typically when this process occurs, we're going through it now. We went through it a few years ago as well with some major tax law changes. There are some grand ideas by a political party or some figures that by the time the final laws are passed tend to be quite a bit of a watered down version. And so there were some major legislative ideas out there, but the current proposals are a fraction of those, and I'm going to hit on those right now. So first is the federal income tax. The chart here shows the top marginal tax bracket going back for the last 100 years. And the proposal today is to raise the highest marginal bracket from 37% up to 39.6. It's a generally modest rate hike. And as you can see, it kind of falls within the trend lines of the last 20 or 30 years, where we've really stayed in a range of about 35 to 45 to 40% for that highest marginal tax bracket. One slightly more meaningful change may be on the capital gains side, where the tax rate on capital gains is proposed to increase on the high end from 20% up to 25%. And that would actually be the highest capital gains tax rate our country's seen in about 25 years. So that's a bit more meaningful there. There are other aspects to the tax law. There's actually many, which I won't go through all of them, but a few that relate to some planning ideas. One is the idea of a Roth IRA, a backdoor Roth IRA contribution and conversion. This was a loophole that's been around for a little while now, and they're looking to possibly tighten up. And another one is really limiting IRA contributions to some of the highest earners. And for all of these metrics, whether it's the income tax marginal bracket, capital gains, or this IRA contribution limit, the discussion is around $450,000 of joint income. So those are the people that will be impacted. The IRA contribution discussion is only also for those who have IRA balances over $10 million. So there are a lot of ideas out there. Some are more on the fringes, some are a little bit more meaningful, but they may impact the stock market and corporations. So Beth, I'm not sure if you want to highlight some of the potential impacts there. And there are clear headwinds, but depending on how those tax revenues are used, those might actually be tailwinds to the economy.
Sure. Yeah. And, we have the higher tax proposals out there for corporations as well. And certainly higher taxes are never a good thing for anyone, including, companies. So it's something we watch for, with our companies. And I'd say at the margin, it's something that can pressure growth, for the individual business. But you make a good point. It does remain to be seen where these higher taxes are ultimately spent in the economy. If they're going for things like infrastructure or clean energy investments, more broadly and longer term, these types of investments are going to be supportive, of growth. But certainly, in the near term, nobody likes higher taxes, including corporations.
Yeah, and if I could summarize a little bit of your comments, Ethan and Beth's as well, it's that there really isn't a dramatic, hitting us in the face type of concern around what's happening with tax policy right at this moment in time. But we understand why that would be a broader concern. And so, here we wanted to highlight the history of U.S. income tax rates back to their origination in 1913. But just in case going back to 1913 was not far enough, and I told you all there would be a little bit of history on today's webinar, we'd like to take those concerns, broaden them out beyond just taxes, beyond just inflation, and show even more data. And so in this case, we're going back to almost the Civil War and showing the S&P 500 back to a 1871 starting point. Just to briefly describe what you're seeing here, this is the S&P 500 on a log scale. So when you back test those numbers and create the index to that date, you have certainly particularly low figures. But nevertheless, the broader point that I think we'd like to make, and Beth, I'd certainly want you to provide your color as well, is that there just are always major concerns that will impact the markets, that will impact the country, the economy as a whole, whether that's the uncertainty around how are we going to deal with the rolling bank panics, and we're going to create the Federal Reserve. What is that going to do for the economy? How is the Federal Reserve in this central bank going to impact financial markets, or even something just more tangible like World War I, World War II, the Great Depression, so on and so forth. So Beth, I guess I would turn it over to you and say, can you speak a little bit about just the uncertainties that are always facing markets and investors?
Sure, Jerry. Yeah, that's a long stock chart there. So, I'd look at the title and say, okay, what we know and what we don't know. We certainly don't know what the next uncertainty is going to be. We don't know what the future is going to bring. But we do know, just like you said, there have always been periods of uncertainty. There are always going to be periods of uncertainty. It's unavoidable. It's nothing new. And for us, it's what we prepare for. We prepare for uncertain times. We often are waiting for them as analysts. And when we get them, that's when we really get to go to work. COVID is a great example of this in action. COVID was one of the most volatile times that I've seen in my career, and market volatility was, just through the roof. And we were incredibly active in the portfolios during this time. We increased our allocation to equities. Our analysts had lots of ideas, high quality, companies that they'd been wanting to get into for a long time, and they got that opportunity on the big pullback. This activity is really what set us up very well from a performance perspective going forward. And I think that our process really shines in uncertain times. I would say, we have had some pick back up in volatility recently. Ethan, you mentioned, maybe not, we'll see, how volatile things get. If we have those types of opportunities, you can expect to see us doing just what we always have, which is getting to work and taking advantage of those opportunities.
Beth, let's bring it back to today like you just did. And one of the most important things that I know you and the rest of the research department look at when you try to make those types of decisions and where you see opportunities are with what is happening with valuations. So can you speak a little bit towards what you're seeing with valuations in the stock market?
Yeah, sure, Jerry. No doubt, valuations are full. This top right chart really shows you, just where we are in terms of valuations. Stocks are expensive. And you can also see this is reflected in our bottoms up process. We've been doing a lot more selling than we've been doing buying in the portfolios. Analysts are looking at their stocks, they're seeing, full valuations, wanting to reduce or sell those positions. And at the same time, they're just not finding as many attractive opportunities and new things to buy or to add to in the portfolios. And that's just naturally how our process works. And as you could look and see, our equity levels have started to draw down a bit as a result of that. But you can also see that in our asset allocation framework as well, where we have actively lowered the top end of our equity range that we target in the portfolios at the margin, so we've made a slight reduction there, as well. And that just ties to the fact that as we look at the markets, we see full valuations. We also have a slower growth outlook and expectations for lower returns going forward. That makes sense that you would start to see those equity levels draw down. I'll turn it to Ethan, actually, if you want to talk a little bit about the fixed income side of things.
Sure, thanks, Beth. On the fixed income side, people don't typically talk about bonds being over or undervalued. They talk about interest rates potentially rising or falling. But the reality is when bond prices and bond yields move inversely. And so with the expectation of yields rising over the next few years, bonds, therefore, are seen as being a bit overvalued. And there is an expectation that the Federal Reserve might raise short-term interest rates 2 times next year and possibly a few times the year after that. And that's going to put bonds under pressure as well. When it comes to different types of fixed income securities, there has been a tightening of spreads between treasuries and corporates and higher yielding bonds more recently, which has made some of those those bonds with higher interest rates a bit less attractive at this time. But as Beth mentioned, the stock market valuations are also getting overvalued right now. And so we get to a point where stocks are somewhat overvalued, bonds are overvalued. Where do you go? And so this is really a time, again, similar to 18 months ago, where Manny and Peer may have the ability to add the most value, actively adjusting client portfolios, moving between stocks and bonds. But those are just 2 of the asset classes that we tend to look at. Beth, I don't know if you want to hit on any other types of investments that the research team is looking at today as areas of opportunity.
Sure. Yeah. Certainly, like we just mentioned, looking at valuations, having that slower growth outlook, expectations for, lower return environments, going forward than what we've seen the past several quarters. So we are actively doing a few things with respect to the portfolios. Number one, I mentioned that, we have actively lowered that equity exposure. So that's one thing there. And then in terms of within the portfolios and looking at some, different asset classes that behave a little differently, we have added a basket of gold miners. And, gold is historically a natural inflation hedge. And some other inflation hedge, type of vehicles that we have in the portfolios as well. We have real estate exposure, both through the real estate fund and also through some individual real estate holdings. And then we also continue to hold a basket of energy stocks. Commodities are also typically, good inflation hedges, particularly in the environment we're in right now.
Beth, let's dive into that a little bit, and just to briefly cover the visual here on the chart as well before we move on to that. This is highlighting exactly that type of asset allocation conversation and those challenges that Beth is discussing. As you can see, the lower yields of today are likely going to make for a more challenging return environment going forward. But back to those specific kind of areas, I think we're all kind of curious. This is your area of expertise, the cyclical sectors, the energy sector, and so forth. Can you dive in and give us a little bit more color on where you're seeing opportunity today?
Sure. Yeah, I'd love to take a few minutes to talk about, what I cover, what I do sort of day to day from a research perspective. Just a warning, it might be a good opportunity to stop and grab a cup of coffee, get a little caffeine if you haven't done so already. My coverage, Jerry mentioned, it tends to be focused on more cyclical areas, energy, chemicals, industrials, these kind of things. Energy is an area I've spent a lot of time on in the past year and a half. We built a large overweight exposure to energy. And if you look at the portfolio at a year ago, this time, we had the largest overweight exposure there. And it's a good example of how we use our hurdle rate strategy to invest in commodity industries. we had the biggest exposure at a time when things looked the worst in the industry. Supply and demand were, the most out of balance. But we saw the conditions in place, and we understood that this imbalance would tighten. There was a lot of investment coming out of traditional energy markets and going into, alternative energies and clean energy. And we understood that while demand, over time, we are going to see a shift in demand, it isn't capable to, sort of shift that quickly. And so we understood that this market was going to really tighten as demand improves out of COVID and can't shift to alternatives that quickly. And that lack of investment left us without enough supply effectively, in the energy market. So it worked really well for us, but buying, into commodity industries is not a buy and hold, type of strategy for us. The hurdle rate strategy, it's a timing-based strategy. And so you would have seen us, more recently selling into the strength, and it has worked well. Energy has been the best performing sector in the market by far, over the past year. We also have been doing a lot of work on the energy transition. We do recognize the fact that there is a longer term demand shift likely to happen there. And then beyond energy and cyclicals, I do look for higher quality, more defensive businesses within these typically more cyclical areas of the market. And a good example of that is packaging. Packaging is actually in the materials sector. It's typically a much more cyclical area of the market, but packaging itself is actually quite defensive. A good example is Graphic Packaging, a company we own. They make things like tissue boxes and cereal boxes, very defensive type of demand, much more like consumer staples than the materials sector. They're also benefiting from the shift from plastic-based packaging to paper-based packaging, which is environmentally driven as well. So, pretty exciting stuff, tissue boxes, cereal boxes. And speaking of exciting stuff, I'm going to talk about another area I cover, which is the industrial gas sector. Industrial gas, it's another very defensive industry within the chemical space. And what these companies do is they supply industrial gas to various companies and businesses that use it in their processes. So something like a refinery, they use hydrogen to lower the sulfur content of their fuel. Hospitals use a lot of oxygen. Party City, uses helium for birthday party balloons. Lots of different end markets use industrial gases, and these companies are really good at producing and storing and transporting these gases, which are pretty difficult to handle. The customers typically cannot do without these gases. They require them for their processes. And so that leads to very stable, strong demand growth. You can see the chart here, the dark green bars, that's showing industry volume growth. So you can see that rarely has demand, ever gone negative for these gases, and that leads to good pricing power. And these businesses also have the ability to pass through energy costs to the end consumer, which is really important in an environment like we're in right now, where energy costs are skyrocketing, and they can, pass those through. So attractive in inflationary environments. But what's really interesting about these industrial gas companies is that they're very good at producing and storing and distributing hydrogen specifically. And hydrogen is getting a lot of attention as part of the energy transition. We use hydrogen in fuel cells, and in that regard, it is a source of energy. It's actually a very rich source of energy, and that's why it's used as rocket fuel. It's used to power spacecraft. And today, producing hydrogen, it requires a lot of energy, and that energy comes from natural gas today. So not a very environmentally friendly approach to producing hydrogen. But it also can be produced by splitting water into hydrogen and oxygen. And that process is called electrolysis. It's a very costly process today, but what's interesting is that if you use solar and wind as the energy source to power electrolysis, you have a very green process. And it really solves a problem for wind and solar. Solar, it doesn't work real well with our needs. We need the lights to shine at night. The sun is shining during the day. How do you store that energy? And turning it into hydrogen is an effective way of actually storing that energy and solving that problem. So it's getting a lot of attention. It's getting a lot of investment. And these companies are really well positioned because they are very strong in how to transport and, store and distribute through pipelines hydrogen, which is a very difficult to handle gas. So I did warn you all to get some coffee before I started. So I'm going to turn it back over to Ethan to take us a little bit broader here.
Honestly, Beth, I always appreciate listening to you and the other members of our research team when you dig that far deep into those topics. And you covered one, maybe 2 or 3 stocks or ideas that we're invested in today. For everyone on this call, Beth is one of more than 45 members of our investment team. It's a broad team. It's very detail focused, industry focused. There's traders. There's everyone. It's very impressive the knowledge that each member of this team has, and that investment research team is one of the key reasons I've chose to stay at Manning & Napier. I'm in my 17th year now, which is incredible to say, but I've stayed here that long because the process has worked, and I believe in it, and you can see the results here. This just shows that over the last 21 months. How effective that research process has been, whether you're looking at conservative strategies or more aggressive strategies, the absolute returns and the returns relative to benchmarks have been very strong over that time period. And we look at this time period because it does include, quite frankly, a bear market, which occurred in the first quarter of last year, as well as a bull market in the 18 months since then. And when you analyze an investment manager, it's important to understand how they've done in bear market and bull market periods combined. And 2020 itself was an example of a time period that included both a positive and negative returns in the stock market. And for those of you that don't know, I am pleased to share with you that Manning & Napier was named by Barron's as the top overall mutual fund family in 2020. This award is a result of overall performance by many of our funds collectively, something we're very proud of. It's a testament to the dedicated long-term process and experience of our research team. So thank you, Beth, and thanks to the other members of the team that helped make that a reality for our clients last year.
Thank you, Ethan.
Yeah, absolutely. I want to reinforce that as well. And, particularly proud to have done it in a year of such turbulence as 2020, which really does kind of tie into all the things we were discussing before. And I know, Beth, you made that point pretty decisively, that when there are times of turbulence, you guys sharpen your pencils, and that's where the opportunities are. And we have shared in the chat as well a link to our awards page. There were a few other awards. You're welcome to take a look. You can read the article, and we encourage you all to check it out. So with that is the end of our normal section of this presentation. I would normally say prepared remarks, but we do have a few other prepared remarks on a couple of pre-submitted questions that we received from a number of our listeners today. And there's 3 of them in particular. And I'm going to go through those, and then we'll do live Q&A after. The first one I do want to send back to you, Beth. And I know this is certainly in the news quite a lot, including most recently. I think the federal government wants to start getting involved to try to solve the problem. But a listener wrote in asking effectively, when do we believe the supply chain shortages are going to end?
Sure, yeah, definitely, Jerry, is a big topic today. It's, certainly playing its role in the uptick in inflation that we have seen. The supply chain crunch, it's sort of multifaceted. It's a function of a variety of different things, some of them being, we have very healthy consumers. I mentioned that before. They have a lot of stimulus in their pockets. They want to spend. So that leads to very healthy demand. On the supply side, we've had a lot of disruptions related to COVID, manufacturing chains that have had to shut down due to illness, due to lockdowns. We also have shortages of key inputs. Semiconductor chips has been a big pinch point in many different industries. We also have labor shortages. I'll talk a little bit more about labor shortages because I think we have another question on that. I would say that the good news is we are seeing signs that the peak, is near in terms of the supply chain disruption. We are starting to see evidence that it's going to be rolling over. Shipping rates are starting to roll over. Port congestion is starting to ease. Production is starting to pick back up, and rail volumes are improving. So all good signs that we think we're moving in the right direction. I would say the one thing to just kind of keep an eye on is that the holidays could still provide some challenge here if the supply chain improvements that are underway, don't come through in time for kind of that swell of demand we get around, holiday shopping, that we could see some continued pressure here. But I think certainly as we move into 2022, we're going to see an improving environment on this front.
Well, I know I for one am looking forward to it as someone who is trying to trade in a car and buy a new one. It is not an easy process right now. So the quicker we can get back to normal, I would say the better. All right, Ethan, I want to send this next one over to you in a little bit of changing gears to financial planning. A listener wrote in asking, given higher tax proposals, what are some planning strategies that we can do today? And I know you've got a couple of different areas you want to touch on here.
Yeah, I'm going to start with income and capital gains taxes, and probably capital gains taxes first, which is where there may be the least planning opportunity. So again, these are all proposals. Nothing has passed yet, but one of the aspects of the capital gains tax rate hike is that it may be retroactively effective mid-September 2021. I mean, sometimes when these laws pass, people frantically try to sell securities or create trusts or do a lot of planning. It looks like, at least under some of the most recent proposals, they've made that not an option for the capital gains tax. That's one thing to be aware of. Now, for the income tax increases, for individuals and families that are consistently in the highest marginal tax bracket, if they have the ability to realize more income this year versus next year, they may want to consider that. I would recommend to hold off on that for now until some of these ideas become much more concrete. But that is something that could be completed later on in the next few months of this tax year. Unfortunately, I will say most of these proposals this legislation is finalized in mid to late December, which is not ideal. But based on history, I would not be surprised if that happens again. But one area that there could be some meaningful tax planning, regardless of if some of the proposals pass, is on the estate tax. And so the chart you're looking at here, at least the top chart, shows the estate tax threshold, meaning how large of an estate can you pass on to your heirs without being impacted by estate tax. And so that's the threshold for individuals. We're at almost 12 million, and it's almost 24 million for families. And that is set to revert and cut in half in a couple of years from now, regardless, but they may cut that in half at the end of this year. And so for individuals or families that have larger estates where they not only would be subject to the estate tax, but do not expect to necessarily spend some of these assets, now could be a great time to look into gifting, setting up trusts, or moving assets from estates. And the thresholds may be estates of 7 to 10 million for individuals and maybe 15 or 20 million for families. At least at that level is where we would strongly recommend a conversation with your accountant, your attorney.
Yeah, absolutely. These are such unique personal topics that if you do want to know more and have a better sense as to how these issues may exactly affect your plan, please feel free to reach out. And then the last question that we have prepared, and this is one, we got a couple of questions on it from different perspectives, but the one that we grabbed here was actually from a client who owns a small business. So I think they're particularly impacted by this, but that's what's going on with the labor shortage today. Beth, you want to talk a little bit about that?
Sure. Yep. Another piece of the supply chain, sort of puzzle as well. We do think, that over time, this labor shortage issue is going to ease. For now, despite the fact that the stimulus payments have ended, the potential workers are not immediately rejoining the workforce, and they're financially healthy, like we mentioned, so they really don't need to rush back into the workforce. Over time, that will naturally correct. The unemployed will deplete their savings. They will need to rejoin the workforce. So I think that element will just naturally correct itself over time. But I also think that there are other factors at play here. There's definitely a measurable impact related to just illness, people that are, suffering from COVID, specifically the Delta variant, they are home, they're not able to work. That has a measurable impact on this. Also things like childcare worker shortages, where there's an impact there, and there's a ripple effect, really. People that want to go back to work that need childcare and can't get it, are sort of forced to stay home. And you can see that in the numbers. The shortage in the labor market is skewed to women, as the lack of childcare is disproportionately, keeping them at home. So, I'd say it's kind of a complex problem, but I do think that as we move forward, it is one that, will naturally, sort of normalize over time.
Yeah, the impact on women, I don't know if that's enough of a told story right now, but I would also say too, the labor shortage, and I guess this ties into the final topic I would like to discuss before we turn to Q&A, is just we have additional commentary on inflation, on wages in the labor market, as well as on some of these smaller, I say smaller, but these bottom-up topics on individual themes and industries and areas of opportunity that we see in the portfolio, whether they're on topics in technology, topics regarding cyclical areas that you discussed as well. So we encourage you all, take a look at our website. If you're not subscribed, subscribe. We hope you'll find value there and additional insights in color on the portfolios. And with that, I'd like to open it up now for live question and answers. So if you have any questions, please feel free to submit them throughout any point during the Q&A process. And as we get going here, okay, we've got a question that I'd like to, and I guess I'm not surprised that this one has come in early. The question asks about cryptocurrencies and is wondering if this is an area we are invested in.
I guess I can take a stab at that at first. The short answer is we're not invested in it today, but as it's become more popular, our firm is heavily researching cryptocurrency right now. It's an area of the market that's quite volatile. It's difficult to value, but it's not a current, I guess, direct investment. With that, though, we are looking at its impact on the economy and on specific companies and businesses and the consumer. And so through that path, we are using crypto or looking at crypto as a factor when we analyze different companies out there.
Yeah, I can chime in a little bit, on the heels of that, Ethan, as well. Just in terms of one of the things we're looking at with crypto is, there's the opportunity, in terms of investing in it, but then there's also, what is the potential risk, associated with something, kind of new and unprecedented in terms of, I think its role here. So we own, companies like Visa, MasterCard, PayPal. They are part of the payments ecosystem. So, that's part of the research that our analysts are doing from that perspective. Like, what's the risk to our, sort of existing holdings? And, I would say there is that, in terms of retail payments, crypto is really sort of more of a solution that's in search of a problem. Our current system, it actually works really well. It's fast, it's secure, it's reliable. Something like Bitcoin cannot possibly handle the volume that it would need to. Bitcoin can handle maybe single digit, types of numbers of transactions per second, where something like Visa can handle tens of thousands of transactions per second. I'd say very few merchants accept crypto payments. It's interesting. They're actually viewed as assets from a regulatory perspective. So every purchase would need to have a corresponding, record for the gain or loss on that asset for tax purposes. So it's really not practical for them to, kind of come into and disrupt that kind of consumer to business payment ecosystem that, the companies like Visa and MasterCard and PayPal and so forth are much more, heavily involved in.
Yeah, it's definitely an area we have our eye on. We are closely monitoring. There's certainly a lot of work being done on it, but right now, a lot of more externalities, I guess I would say. So the next question I want to send your way, Ethan, where is the best place to put newly acquired money, sale of property, or gift if retiring within 5 years? I know that's a particularly specific question, but any thoughts on that?
Yeah, it's specific, but it's actually become a pretty common question that I've gotten recently. Maybe not the 5-year time horizon, but a number of clients and families are selling second homes, are selling properties, and are somewhat avoiding reinvesting it in the real estate market right now with where prices are. And so a lot of it, you mentioned, I think, a 5-year time horizon in the question. A lot of it's going to be based on, in those 5 years or after those 5 years, what is the withdrawal constraint going to be for that portfolio? When we look at determining a suitable investment strategy, we look at not just time horizon, but the withdrawal needs and risk tolerance, because the real risk would be if in 5 years or whatever time period the money is needed, if it's a time when the stock market or the markets as a whole are down. And so the risk is not necessarily volatility, it's volatility when you need the money. And if as time horizons shorten, we tend to propose more conservative portfolios, and hypothetically a mix of stocks and bonds may be suitable, but depending on that actual withdrawal need in the future, it could be a larger or a smaller weighting to stock.
All right, and Beth, I'd like to send this one your way. And Ethan, again, feel free to chime in if you have anything, but Beth, what will be the impact on the market if the infrastructure bill is passed or not passed?
Sure. Yeah, I think big picture, if it gets passed, it's supportive for economic growth, more broadly and longer term. I think one of the key things that it would serve to do for the markets and for businesses is a lot of it is targeted at improving our freight system and improving our transport system, which we've seen come under pretty tremendous stress recently. We talked a lot about that. That has been an issue for companies that has resulted in stalling growth for them when they can't get the raw materials that they need to operate their businesses and so forth. So I think it would have a real positive ripple effect, through the economy, longer term. It would also provide a lot of support for the clean energy space and that transition. We've been doing work there. There isn't really any renewable options right now that aren't reliant on government support to continue to accelerate. And that support is what helps costs come down in the industry and make it, more, allow demand, to really start to accelerate. And so that would be an important aspect of it as well. We actually do have some companies in the portfolio that are beneficiaries of an infrastructure bill. I'd say a couple direct examples are a couple of the aggregate companies that we own. And aggregate companies, they mine and they process, crushed stone, gravel, construction sand, these kind of things that are used in building roads and buildings. So those would be, some direct beneficiaries, as well.
Let me ask you one more, see if we can squeeze this one in here. Beth, we have a listener writing in asking if you have any thoughts on the auto industry transition from gas to electric and perhaps the opportunities that might offer.
Sure. Yep. I can talk a little bit about that. Auto, it's not in my coverage. It's actually in the consumer group's coverage, but we've been doing a lot of work on this space as part of a larger sort of holistic cross-group project that we're working on in terms of the clean energy space and the energy transition. And electric vehicles have been one of the things that we have been working on there as well. And I know that our analysts in the consumer group have been diving in there, as well. It's interesting. The auto industry has never been a space we've been particularly keen on investing in. It's not a particularly, strong industry from a strategy fit perspective for us. That said, we do recognize the demand shift that is going on there. I do think it's interesting that we are seeing, that shift in demand. It is occurring and it is happening. I think it's probably happening a little bit slower than folks naturally would realize. When you look at the new sales that are, shifting to and going to electric vehicles, the number is growing and it's expected to keep growing. But when you look at what we have in terms of the electric vehicles in terms of the total, global fleet, it's like 1%. It's still pretty small, and it's going to take a long time, for it to get there, there's a lot of challenges along the way. There's a lot of chicken and egg issues. You want to buy an electric car. We just went on a trip to Philly to take my son to visit colleges. Where would we charge that vehicle, on that trip, and how would we sort of manage that? So there needs to be a certain amount of infrastructure, built, I think, for this adoption to continue to really accelerate. But I think it is moving in that direction, and I think it's an interesting space. And like I said, our analysts are all kind of interested in working on it as well.
It makes me wonder whether I need to give more thought to going to look at some electric vehicles along this car shopping journey that I'm struggling on right now. At any rate, thank you all, Ethan, Beth, thank you both for being here today. And unfortunately, that's all we have time for. But if we did not get to your question, we'll be sure to follow up after today's presentation. And as a reminder, a recording of this webinar will be emailed out shortly afterwards as well. This was a lot of fun. Ethan and Beth, thank you both for being here today.
Thank you.
My pleasure.
And to our listeners and clients, thank you for attending today's quarterly webinar.